So welcome back to session 5 of the Geometric Trading course, Apprentice Level 2. In this session, we're going to cover off the first of a number of filters that we might want to choose to add to our core trade setup. And the first one we're going to be looking at is the ZBD line. So the ZBD line has its roots in a number of different technical methods out there. Going back in time, the Dunnigan thrust method, the Three Little Indians by Linda Raschke, the Three Drive Patterns by Larry Pesavento, and last but not least, the Wolf Wave by Bill Wolf. And of all these different methods, the strongest similarity that the ZBD has is with the Wolf Wave. So we're going to talk about that for a little bit. It's interesting, Bill said it was not invented but discovered by him. I'm yet to find out what that means, and when I find out, I'll let you know. But it was first mentioned publicly in the book Street Smarts by Larry Connors and Linda Raschke. I looked at this in the 90s. And but if you want to learn more about Wolf Wave, Bill teaches a course called Wolf Wave. And you can see the website there, wolfwave.com. But apparently Bill and a number of other traders made a significant amount of money trading with this technique on the floor of the Chicago Board of Trade. So what is the Wolf Wave? As mentioned in the book, we're going to be looking at an example here of a bullish Wolf Wave. And you can see that the labels are different from what we're used to with the X, A, B, C, D. And Bill uses these labels here, 1, 2, 3, 4, 5. And so this would be our A, B, C, D. And that's how it relates to our labeling. Now, of all the different lines that we're going to be showing you on the screen here, the most important one that we're going to be taking away from the Wolf Wave technique is this one here. Bill refers to this as the 135 line. The other lines I'll present on the screen will be in a different color so that you'll focus on the one that we're going to use here. So technically, we're not stealing the Wolf Wave technique here. We're just using one of the lines that originates prior to the A point at that low there at 1. Okay, we're simply drawing a line from here to there, and we're going to extend it. So you'll see by the end of this thing, it's not Wolf Wave. I'm just showing you when I learned about Wolf Wave, I used this technique and it seemed to work well. And so over a period of 15 years, I've changed it around so that it doesn't even resemble the Wolf Wave technique. It's a different line that helps us find that what we're looking for over here, which is the D point. But back to what Wolf Wave looks like. He would draw a line like this, and then he would draw another line here. So if you're a Elliott wave guy, this is the end of wave 4 before we get up to the end of the impulse here at A. But he would draw a line from here to our C point. He calls this 4. So you draw a line there and he extends it off into the future over here. He'd draw another line. It's getting kind of cluttered here, but he would call this point 2. We call it A. If you draw a line from A down to C and extend that, you see that these two lines intersect over here. Now, this is what you hope is going to happen if the market bounces off our D point here or his 5 point here. It will move up. Now, the expectation is that it's going to move up from this low up to this line that we drew here, and he called this estimated price of arrival, or EPA line. That was the expected move for it to go up to here. He also would mention ETA, estimated time of arrival, that would actually get up here. How long would it take? Well, he would look at these two lines where they would intersect, And if you just draw a vertical line straight up from there, he'd say it should hit this price and it should hit it at this ETA point in time as well. So that kind of is a quick summary. Apparently the methods are a bit more complicated than this, but in the Street Smarts book, this is what Linda presents in the book. Now, if you're a Elliott wave guy, you've probably noticed, wow, this is kind of looking like Elliott wave here. 1, 2, 3, 4, 5, and a wave 4 here. And then we got this ABC correction. Yes, this is one of the first things that got my attention too, is the relationship that this has with Elliott wave, where Wolf wave is assisting you in the determination of where is the end of wave C, and if there was going to be a move, how far it's going to go. So if you're skeptical about this technique and you like Elliott wave, hopefully this will build some confidence in this technique. Now, the interesting thing is that Bill also used parallel lines or parallel channels like Elliott did to identify the end of a correction. Now I'll show you what that looks like. Okay, so we already looked at this line here. But in addition to this line, he would draw a parallel channel. Okay, so in our world of labels, this would be A to C. Okay, draw a line there and then draw a parallel channel of that line that would originate over here at B. So copy and paste this line here. Paste it right here, and you can see that 2 green lines are parallel channel lines. And so Bill would mention with the Wolf wave technique, he'd draw this 1, 3, 5 line, but he'd also do the parallel channels. And so he'd say, okay, well, where's the market going to go? Is it going to bounce off this green line, or is it going to bounce off this red line? Well, he would identify the area between these 2 lines as the sweet zone. He would expect that there'd be a reversal between these 2 lines. Sometimes the lines land right on top of each other, and that's what we could call a narrow sweet zone. That would be a super sweet zone if it's like that. But typically it doesn't look like that. It looks like this. Now, we don't have to worry about drawing these parallel channels as discussed in the previous lesson about the quadrilateral. I'll put a quadrilateral on top of here, and you can see that that basically is giving us this green parallel line anyways. So really the only thing that we have to draw in our analysis is this 1, 3, 5 line, or as we'll see, I call it the ZBD line. I'll show you why here in a minute. So I don't know if you remember in the Gartley Trading Method book, I introduced the WX label. And that was because this significant leg is missing from most modern Gartley patterns. So we reintroduced that in the book, but I had to come up with some labels. Now, Larry Bezzavento came up with the X, A, B, C, D. So what are we going to call this leg over here? So I came up with W because that comes before X. So we call that the WX leg. Now that we're using this line here, we know it intersects with B and D. What are we going to call this point here? Well, if we call this W and this X, we could call it Y. But I reserved Y for this high over here, so I'm going to call this one Z. That's where I came up with the Z for that. So we're not going to call this the 135. We're going to call it the ZBD line. I just want to mention now, previously in the Apprentice Level 2 course, I used the ZBD line in a general way to confirm where a D point is. But in much the same manner that I was not happy with a never-ending horizontal line, 786 line, there has to be a limit on how long this line can go on in regard to our ZBD. Do we extend it off to the right forever, or is there an expiration date on this line? So in this revision of the Apprentice course, we've made a significant change in how we use the ZBD line, a more quantifiable way to use it to filter your trades, and this is what I've found is best. If you draw the ZBD line here, draw from Z to B, and you just draw a simple trend line, copy it, and paste it at B. Often there's a cycle present from the Z low to the B low, and that often would equal a low to low cycle going from B to D. So it's a little bit more accurate than just using the line in general sense. The best thing about this is that your D point of the ZBD line is an exact point in price and time that you can use to identify the D point. Why is that good? As we're going to find out later in the course, what you want to be looking for are specific points in price and time that you can plug into a computer to create an algorithm. That is the best way to quantify all these geometric trading techniques. And so that's why I've had to make this change with the ZBD line. A little bit more accurate. It's not going to be as apparent on a lot of trades if you like to do a lot of trading, but as I've said before, I'd rather have fewer trades showing up that have a higher probability of working than a bunch of trades that don't work as well. So at the end of the day, what are we looking for? We're going to use that ZBD line to confirm what angle of the Beck's emblem that we're going to be trading off of. So just in the same way that if we put a quadrilateral on top of the emblem, we see the tip of the quad pointing to the 52, we'll be drawing a ZBD line. We're hoping that the tip of the ZBD line is closer to 52 than one of the other angles on the emblem. And if that's the case, then we've used our filter to filter the trade to determine which angle the market should react to. So let's look at a real-world example of our ZBD line. Here's Citrix Systems with the potential for a bullish 52, X, A, B. We're going to find out where B is over here with our quad. First, we're not sure yet until we put the quad on here. It's probably going to be this one. C, potential D. So let's put the emblem on here. I'm going to choose this low because it's the these two are very close to each other. I'll put it up there. Psychologically, things really started to move from this point forward, so this would be the low that I'd choose. Up to here, I've already taken the liberty of locking up the time and the price axis down here on the bottom right. You can see that C is lining up with that, so we know that the quad is going to be lining up with the side of the tetrad anyways. But let's put the quad on here. So I'm going to choose this one. I'll show you why here in a minute. We're doing the alternate method. I'll turn the lock off. Okay, there we go. So you can see now why I choose this low versus this low. As we know, when we're using price extensions, we probably would have used this one. But we're going to use this one here. Why? Because notice how it fits this angle here of the quad. Most of the price action here is following the direction of the quad. So that's a good example of that. Now notice how the tip of the quad is close to the 52 here. So now we're talking about using the ZBD line. Let's draw that now. So I would choose this as my Z point. Now we're going to draw a simple trend line from here. Turn on the magnet. So here's our Z point. To our B point. Okay, so I've double clicked here. We now have a segment of a trend line. The easiest way to do this is simply to click and drag this segment over and then drop it right here. You notice that? This point right here at B. Now the tip of this, I'm not drawing the whole line here. Remember, I want to see equality from Z to B and from B to D, and that's what I've got here because of the segment. Now I check out the tip of my ZBD line here, or BD line if you wish, and we can tell now that it is closer to 52 than any of the other angles. So we got a nice zone here where we expect a reversal to take place. So once again, this ZBD line has confirmed that I'm expecting a reversal at the 52 here. Let's add some bars. Okay, so this bar touched the 52. That confirms our trade setup is complete. Now it'd be a matter of putting this position on. I can do that with a single in scale out methodology if I use the range of this bar. If we want to buy at the high of this bar and put the stop below the low of this bar, that would identify a risk in this trade. So let's say we do that. Okay, so there's our single in scale out methods based on the methodology and the Gartley trading method. And so if the market goes above 16 here, I'm in, and I'll put my stop in all 3 units down here. Let's add some bars. Okay, so I would have been filled here. I put my stop here. Waiting for the market to hit the first target at 1726. And it does. So we would liquidate one position here, 1/3, and we're going to move our stop up from here to 1473. Looking to hit the second target here. And there we go, hit the second target. We move our stop up here to our entry point at 16. Add some more bars. And it's weakening here a bit, and so that would have cleaned us out on the last position here. Wouldn't have lost money on that one, but we would have made money on the first two. So net position, we're overall profitable on this trade. So that's just an example of using the ZBD line to confirm our bullish 52 trade. Let's look at another example. Here's a potential bullish 52 on Marriott on the S&P 500. We're going to first of all draw the emblem. Obviously a trend continuation one. With the potential of the D point over here. Always wait for the break of the low of the B before you start doing all your analysis, because it's a little premature to do it prior to that. But once it goes below here, we can start looking around for things. So I've already taken the liberty of scaling the chart here. You can see the C point is lining up with the tetrad there. So we're going to put the quad on here anyways. Okay, there's the quad. Another quick way of doing the same thing as this quad, finding out if the tip of the quad gets to one of the angles, is simply drawing a trend line from A to B and then dragging that over here like that, so you can see how that works, right? Let's get rid of that. Okay, so now we're looking to draw a ZBD line. We go to trend line. This is obviously the Z point. Draw the line to the B here. And then we're just going to drag that over. Like that. Okay, so that looks pretty good, doesn't it? When it lines up exactly with the same angle as the quad, that's a dream come true. I refer to that as Hadrian's Wall when you have that going on. So the tip of this ZBD line is closer to 52, just like the quad tip here. So we're looking for a buy signal over here. So let's add some bars. Just about. Okay, there you go. So our trade setup is complete here. We've hit the 52. Now we're looking for an entry signal. And I like to use, in this case, the high of the low bar. So I'm looking, if the market takes out this high of this bar, I'm going to be long. And I'll put the stop below here. So I'm risking the range of this bar. So we'll add another bar. Okay, so we have a new low bar. We didn't have this high taken out. So now our rules are to buy on the high, one tick above the high of this bar. And if that happens, we put the stop or our risk on all three contracts down here below this low. Add another bar. So this shows our order would have been filled right here. So I'm going to use my single and scale out tool here to identify what our risk is. Drag that over here. Okay, so based on these rules, I would have been already out of 1/3 of my position at 1734. We're looking to hit the second target. My stop would have been already moved up to here to 1678. We add another bar here. We hit the second target. That means we've liquidated 2/3 of our position, and now our stop on the remaining third is here at 1706. And it's at this point we can use our 3-bar trailing stop. Okay, which is currently set at 1674, which is below our entry point. So this 3-bar doesn't kick in until it starts going above 1706. So let's just add some bars and see what happens with this. Okay, so there you have it. The 3-bar trailing stop did move above 1706, and you would have liquidated the remaining third at 1727. So if you look at the history of this trade, it did go straight up after this, but oh well, that's the reality of trading, right? Okay, let's look at another example. All right, let's change it up here. I'm going to show you a bullish 38 on IBM. So first off, let's apply the emblem. Notice how the market respects this arc here. That's kind of cool. How it bounces off this angle here. And we're looking for it to find support here. Once again, just a reminder, the tip of the tetrad, make sure that it's above the X point here, which it is just a little bit, so we're still bullish on this trade. So let's apply the quad. I've already scaled the chart. I would choose this to draw the quad versus this low. As you can see, I'm going to draw this in the alternate method, using this low and this high over here. See how everything is contained inside there. Now, a reminder with the ZBD line, your B point is always dependent on what you choose for B on the quad. Just a reminder. So let's go over here. We're going to draw our trend line from Z to B. And we're going to drag that over here. And once again, very close to the side of the quad. We'd like to see that. Closer the better. The tip of the ZBD line is closer to the 38 than the 52 or any other angle. We wouldn't be wanting to trade off the 52 anyways based on this trade setup. As you can see, it's sloping down. That would not be a bullish signal. That reflects the idea that this tip of the tetrad is above the X point here. Anyways, we're doing the bullish 38. We've just confirmed that this is the angle we want to trade off of. And now let's add some bars. Okay, so our trade setup is complete. We've hit the 38 exactly at the tip of the quad. Kind of uncanny how sometimes these things happen. But now we're going to be using the high of the low bar to enter this trade. So if we go above this high here, we're going to be long and risk this much money from this high to this low. Let's add some bars. Okay, still no new low and not taking out the high. We now have a new low bar. That means we're going to buy above this high. And this will be our stop down here if it happens on the next bar. Still nothing. We got a new low. So we're going to buy above this high, put the stop here if that happens. Let's add another bar. A new low. Buy on the high of this bar here. Okay, finally we get filled. We're risking the range of this bar, so we'll use our single in scale out tool here. Click the high, click the low. That's our risk. So this bar, we would have been filled on this day on Friday. Hit the first target and the second target the same day, and our stop would be at 91 here on the remaining third of our position. Now we can apply that 3-bar trailing stop as long as it's above the red line or 91. We'll use that. If it hits 91 first, then we're out at 91. So let's add some bars here. Still the stop is at 91. Notice how the 3-bar trailing stop is not above 91 yet. Okay, so now we're using the 3-bar trailing stop. It's above 91. Okay, and stopped out at 93.74. All right, so that was just showing you how to do a bullish 38. So let's review what we covered off here today. We learned about some new labels we had to add to our chart to identify the Z point. We learned about the WX in the Gartley trading method, but now we've added Y and Z. So that's why we call it the ZBD line. We looked at the origin of the Wolf wave as well, going back to the 90s and Street Smarts, and how there was that 135 line. This is an evolution of that. It's a better way to use that line. And by it being equal from A to B, when that A to B equals C to D, we get a specific point in price and time that we can use for quantitative analysis. What we want to do is make sure that the tip of the D point is closest to whatever angle that the quad is pointing to. So most of the examples that we looked at here had to do with a 52 angle. We looked at one example of the 38, but just use this as a filter to confirm your core trade setups. This is the first of a few that we're going to be looking at. But in the next session, we're going to look at another filter that we can use with our core trade setup, and that is time and price vectors.